Let's talk about commercial lending, shall we? Now, I know the term might sound a bit intimidating, but I promise you, it's not as complicated as it seems. In fact, commercial real estate financing can be one of the most powerful tools in your business toolkit. Think of it as a long-term, asset-based loan that not only helps you acquire property, but also manages your risk effectively. Unlike those short-term business credits that can feel like a ticking time bomb, commercial mortgage loans give you the breathing room you need. So what exactly are we talking about when we say commercial mortgages? Well, in the United States, commercial lenders are in the business of offering loans that are backed by hard collateral, typically real estate. These loans, known as commercial mortgages, are secured by properties like office buildings, shopping centers, industrial warehouses, or even apartment complexes. The money you get from these mortgages can be used for a variety of purposes: acquiring new properties, refinancing existing ones, or redeveloping spaces to fit your business needs. Now, let's break down some of the key features of commercial mortgages. First off, they come with structured terms. This means that they're customized to fit both the borrower's and the lender's needs. You've got your loan amount, interest rate, term length, amortization schedule, and even prepayment flexibility. It's all about finding that sweet spot that works for you. Next up is underwriting and due diligence. This is where lenders do their homework. They dive deep into financial reviews of both the property and the owner. They'll look at third-party reports, like appraisals, to get a full picture of what's on the table. It's a thorough process, but it's there to protect everyone involved. Now, let's talk about collateral. This is a biggie. Lenders take a hard look at the type, quality, and equity of the collateral you're offering. Many commercial loans are bridge loans, which means they come with higher rates but offer speed and flexibility in financing terms. If you need quick access to funds, this might be the route to consider. When we talk about commercial real estate financing, it's important to understand that it operates similarly to residential mortgages. You're using real property as collateral against a loan to buy or refinance that property. But here's the kicker. Businesses can also borrow against the equity in properties they already own. This gives you more options to play with. Just like residential loans, commercial mortgages require regular payments of principal and interest, and they can have fixed or variable rates. The lender keeps a security interest in the property throughout the loan term, which means they have foreclosure rights if things go south. Now let's highlight some key differences between commercial and residential mortgages. First off, commercial mortgages are designed for business entities and various commercial properties, while residential mortgages are geared toward individuals looking to buy homes. This distinction leads to a different risk assessment. Commercial properties are often viewed as higher risk due to their limited marketability and higher default risk. As a result, lenders tend to be more conservative in their underwriting, which means you might not get as generous terms as you would with a residential mortgage. And let's not forget about cost and complexity. Commercial mortgages are generally more expensive and complex to process. We're talking larger loan sizes and a detailed due diligence process that can feel overwhelming. But don't worry, I'm here to guide you through it. Now, if we look at the standard characteristics of a vanilla commercial mortgage loan, we can spot a few key elements. First, there's the debt service coverage ratio. Lenders typically require the property to generate 1.0 to 1.25 times the monthly mortgage payment in net rental income. This ensures that the property is not just a pretty face, but also a solid investment. Then we have the down payment. Generally, you're looking at a minimum of 20 to 25% down. If you're dealing with riskier properties, or if you're a newer company, that percentage might go up. It's all about managing risk from the lender's perspective. And let's not forget about prepayment penalties. Many commercial mortgages come with de-escalating prepayment penalties, which means they reduce over time. This can be a lifesaver if you find yourself in a position to pay off your loan early. Now, where can you find commercial real estate financing? There are several sources out there. You've got commercial mortgage brokers who can shop around for competitive rates. Then there are commercial mortgage-backed securities, which are pools of commercial mortgages sold to investors. Regional banks provide traditional lending options, while private equity companies might offer more flexible, creative financing solutions. And let's not overlook specialty finance companies, which include conduit and hard money lenders for quicker, less documentation-heavy loans. If you're considering going down the commercial lending route, preparation is key. You want to have your ducks in a row before you approach a lender. They'll typically require property information, a 2-year income and expense statement for the property, rent rolls, a personal financial statement, and 2 years of personal and business income tax returns. Having these documents ready can save you a lot of headaches down the line and help you avoid any surprises. So if you're ready to explore your commercial mortgage options, I'm here to help. At Medallion Funds, we specialize in making the lending process as smooth as possible. Let's work together to find the best solution for your business needs. Remember, commercial lending doesn't have to be complicated. With the right guidance, it can be a straightforward and beneficial process. Reach out to me, Bill Rapp, and let's get started on your journey to securing that commercial mortgage.